Hello students, this is Professor Vicente Saga. Welcome to my class. This is part 4 of the presentation of chapter 14, long-term liabilities. I noticed that I misspoke in part 3 when I said the company is still in the business of selling the bond. That is not what I meant. I meant the company is still interested in selling the bond. There's a difference there because the company is selling the bond to raise funds. That is not the business or the main reason why the company is in existence. So I just needed to clarify that. Moving along, let's take a look at the illustration of the important concept that we just discussed in part 3, talking about the relationship between two important interest rates in connection with the value or the price of the bond. So here's an example. This bond is issued at par on interest day. So this company issued at par 10-year term bond with a par value of $800,000 dated January 1st, 2014 and bearing interest at an annual rate of 10% payable semi-annually on January 1 and July 4th. It records the following entry. So clearly, this is issued at a par value. So the company received $800,000. So cash is debited for $800,000, and bonds payable is credited for $800,000. And of course, because the bond is issued at par or sold at par, the market interest rate and the stated interest rate obviously are the same. So moving along, that is on January 1st. Now let's take a look at what happened. And we said that the interest is paid semi-annually on July 1st and January 1st and July 1st. So let's take a look at what happened on July 1st. We have to pay interest. How do you calculate interest? It is the principal or the par value multiplied by rate, in this case 10%, and multiplied by time. Now we are talking about 6 months. So half or 612. So if you do that math, that gives you $40,000. So interest expense is $40,000, cash is $40,000. I want you to make a note of something that is very important here. The interest expense and the cash are exactly the same when the bond is issued at par. When the bond is issued at discount or premium, that is not the case. And we are going to come across that in a minute. So on December 31st, at the end of the year, remember now, the next interest payment is January 1st. So on December 31st, we have to accrue for the other interest. So we have $40,000. We have to accrue for interest for the next 6 months, which is due for payment the following day. So we have interest expense of $40,000, interest payable for $40,000. Now, so that is very simple, straightforward. That is an example of a bond that is issued at par. Now let's take a look at bond issue at discount on interest date. So in this situation, $800,000 bond is issued on January 1st at 97. The 97 means 97%. 97% of the par value or the principal. So I'm bearing interest at an annual rate of 10%, payable semi-annually on January 1st and July 1st. It records the issuance as follows. So the company is selling the bond at 97. So by the way, we have two ways of calculating the value or the price of the bond. One approach is we give you the percentage is issued at a particular percent. In this case, 97, meaning 97%. If it is 102, that means 1 or 2%. Another approach is to calculate the present value of the principal and the present value of the interest payment and add those two numbers, and you have the present then you have the value or the worth or the selling price of the bond. So those are two approaches. This one is easier than the first one that we illustrated. Very likely you are going to get both. You are going to get both on your exam, especially the one that is a little bit the one that is more complicated, because that is the one that is tested the more on the CP examination. So moving along, so here 97% of 800,000 will give you 776,000. The bond payable is 800,000. So the difference of 24,000 is discount on bond payable. Excuse me for a minute. So now it is very important for you to know this. This is how we record the entry, or record the transaction rather, on the date of issuance. Now, on that same day, if we were to present or report this on the balance sheet, here is what would have happened: assets, liabilities. So bond payable has a normal credit balance, in this case 800,000. Discount on bond payable is a contra account to bonds payable. What do you mean by that? You know that the contra account is an account that offsets another account. So since discount on bond payable is a contra account to bonds payable, it has the opposite normal balance. So the normal balance is debit. So for reporting purposes, we have here discount on bond payable. Here is $24,000. So we have $776,000. $776,000. If we were to report the bond on day one. So what are we talking about here? On day one, as you can see, we received $776,000 from the investor or from the bondholder. On day one, we are also obligated, we call this 776 carrying value. We are obligated to pay the bondholder only $776,000 on day one. But as time progresses, by the time we have an opportunity to use the form, of course, we are not going to be responsible not only for the 776,000, but a portion of this as time progresses. Eventually, we'll be responsible for all of these. At the end of the life of the bond, then we'll pay 800,000. So we're going to talk about the intricacy of how to reduce the $24,000 in a few minutes. So suffice it to say, this is the entry that you make at this point. You debit cash, 776, because that is what you are selling the bond for at discount, less than par value. You credit bond payable for 800,000. The difference of 24,000 is discount on bonds payable. Now, let's assume that we are using straight line method to allocate the $24,000 over the life of the bond. In this case, a 20 period, because this is the discount is amortized to interest expense each period for 20 periods. Yes, for 20 periods. So we are going to divide the $24,000 by 20 periods, and that will give us $1,200 for each period. So now let's take a look at how we deal with that. This is very important. Remember, I said that the cash interest payment is always calculated. You have to remember this. The stated interest rate, the interest rate on the face of the bond multiplied by the par value. If you do that, the cash payment is $40,000. Now, this $24,000 discount, when you sold the bond less than par value, that $24,000 is actually additional interest expense you have to deal with. So the cash interest payment is $24,000. The interest expense is $41,200. Why? Because $1,200 of the $24,000 discount is now part of your interest expense. Recall, when the bond was issued at par, the cash interest payment and the interest expense the same. In this case, the interest expense is higher because we have to deal with that discount, that $24,000 discount, one way or the other, and that is what we are doing and allocating. As you can see, we are crediting discount on bond payable. By so doing, we are reducing it by 1,200. So on December 31st, take a look at what happened. We did the same thing. The only difference is we are accruing for interest, and the interest payable is being credited for $40,000. So moving along, let's take a look at the bond issue at premium on interest date. So the company issued $800,000 of bond on January 1st, 2014 at 103. 103 meaning 103%. And that means 103% of the par value of 800,000. So the company is selling or issuing the bond more than par value. Same pass here. So 0.103 multiplied by 800,000, that will give you 824,000. So the premium on bonds payable is credited for 24,000 and bond payable is credited for 800,000. So just the opposite of discount. So take a look at what happened here. Now, if we were, how much did we actually receive? We received 824,000. But we are going to pay the bondholder 800,000 in due course. Why? Because our stated interest rate is higher than the market interest rate, and the investor is willing to pay us more and receive less in the future. So we are making up for that difference in interest rate as we previously illustrated. So as you can see, the bond payable is 800,000. The cash that we receive is 824,000. The premium on bonds payable is $24,000. Now, if we were to report this on the balance sheet, the bond payable will be 800,000. The premium on bonds payable will be 24,000. Premium on bond payable is plus. We add it to bond payable, and here we have 824,000. So on day one, we receive 824,000. We are obligated to the bondholder for 824,000, because if both parties were to change their mind on day one, of course we have to return 824,000. But at the end of the life of the bond, we'll be paying only 800,000, because we would have paid the bondholder a higher interest rate over the life of the bond. Moving along, so let's take a look at the impact of premium on interest expense. So on July 1st, again, this is bond issue at premium. Take a look at what happened. Again, it's very important for you to know this. The cash interest payment is always calculated the same. The stated interest rate multiplied by the par value. We did this before. So the cash interest payment is $40,000. However, the $24,000 premium on bonds payable with a normal credit balance, we now have to reduce it by $1,200, because we are splitting the $24,000 over 20 interest payment periods. So when we reduce the premium on bonds payable by $1,200 by way of debiting that account, as you can see, our interest expense is only $38,800. So what are we saying here? The amortization of premium on bonds payable reduces our interest expense, just like the amortization of discount increases the interest expense. So in this case, the interest expense is lower than the actual cash payment. For discount, the opposite was the case. Then, of course, at the end of the year, we accrue for interest. Instead of crediting cash, we credit interest payable, because payment is not due until the following day. So, let's take a look at another issue here. Relative to valuation of bonds issued between interest date. What are we talking about here? When companies issue bonds on other than the interest payment date, Buyers will pay the seller the interest accrued from the last interest payment date to the date of issue. On the next MI interest payment date, purchasers will receive full 6 months interest payment. So what are we talking about here? Very simple. Interest is paid every 6 months. Let's assume June 30th and December 31st of the year. However, when an investor buys the bond right in the middle of the first 6 months, in this case March, we ask the investor to pay us the first 3 months interest along with what the value or the price of the bond is, so that by the end of June we are going to pay the investor 6 months interest. So the investor cough out the first 3 months interest plus the selling price. Then in 6 months we just pay the investor the full 6 months interest. So that is basically what you need to know here relative to bonds issued between interest dates. Here is an illustration. So here on March 31st, T Corporation issued 10-year bonds dated January 1, 2014 with a par value of 800,000. These bonds have an annual interest rate of 6% payable semi-annually on January 1st and July 31st. So bond issue plus interest. So here's what happened. The interest between the last interest payment date and the date the bond was issued or sold was $8,000. So the company received $808,000, bonds payable $800,000, and the interest expense is credited for $8,000. As you see here, interest expense is being credited. That is very unusual because interest expense is usually debited. Okay, an increase in interest expense or any expense for that matter we debit, but here we are crediting interest expense. Why? Because we are receiving interest that we are going to eventually pay when we make the full 6 months interest payment. So take a look at how it works out here. So in 6 months when we actually make the payment, look at what happened. We pay interest expense of $24,000, cash of $24,000. So the balance will actually be $8,000 credit $24,000. So in actuality, the interest expense net amount is $16,000. Bond issue between interest date, same thing. In this case, par value, and I think this will be a good time to wrap up this presentation for part